You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, I've got a terrific show lined up for you today in light of the crazy market events of this past week, which we will dig into here momentarily. Joining me in segments 2 and 3 of today's program is the founder of Pento Portfolio Strategies and the host of the Midweek Reality Check podcast, Mr. Michael Pento. If you watch any television, Michael is often a commentator on all things economic and financial. Excited to share my conversation with Michael from this past week. I caught up with him Tuesday this past week after we saw the Japanese markets drop 12% in one day. And of course, that had effects on U.S. markets as well. I'll be talking about that in this segment as well. Before I get to that, though, let me remind you that I do have available for you a free special report titled Tax-Free Retirement Income Strategies. In my view, it has never been a better time for you to get your hands on this information. We have lower income tax rates in 2024 and 2025 before tax rates reset to the higher rates that were in effect in 2017. That happens January 1 of 2026. And there are terrific strategies that many taxpayers can use to reduce the taxes they'll pay on retirement accounts like IRAs and 401ks. And that is the topic of this month's special report. Again, it's titled Tax-Free Retirement Income Strategies. To get your copy of that report along with some bonus information, just visit requestyourreport.com and let me know where to mail that report. Again, requestyourreport.com is where you go. Just give me your name and address. I'll drop that all in the mail to you absolutely free and with no future obligation. So when you take a look at what happened last week, the Bank of Japan, which is Japan's version of the Federal Reserve, it is the Japanese central bank. The Japanese central banks increased interest rates very slightly, and they did it to try to prop up the yen. Now, over the past month or so on this program, I've talked about trade-offs that central banks have. And central banks really, at this point in time, in my view, have a choice of managing inflation through tighter monetary policies. That's essentially what the Federal Reserve has been attempting to do, get inflation under control by increasing interest rates. Now they're talking about rate cuts because the economy, which is addicted to easy money, is beginning to suffer. So the trade-off is simply this. You can manage inflation or you can try to keep the economy and the markets moving higher, but it's very difficult to have both. Japan's central bank this past week decided they were going to try to prop up the yen, and immediately the Japanese markets dropped in one day more than 12%, in a month more than 20%. And of course, that had effects on U.S. markets as well. And as I said at the outset, I'll be talking to Mr. Michael Pento about that in the next couple segments. Now, past guest here on RLA Radio, John Rubino, published an interesting commentary last week before all this occurred. And his commentary was titled, Japan Enters Its Death Spiral. Pretty interesting title to a report that was written prior to this latest big decline. Now, Mr. Rubino's piece does a nice job of explaining the decision that, in my view, every central bank in the world will eventually face. Choose which you will save. Will you save the economy? Or will you save the currency, but you can't save both? I want to give you a bit from John's article. He says this: confronted with both a plunging yen and rising interest rates, Japan was recently forced to address one of those potential crises. It chose to protect the yen by raising short-term interest rates and using the dollars in its foreign exchange reserve to buy yen. This arrested the yen's decline. In other words, the yen relative to other currencies around the world, and certainly relative to gold, stop declining at the same rate. Rubino continues by saying, remember, Japan is in a box where fixing one crisis exacerbates one or more others. In this case, a resurgent yen. A rallying yen makes Japanese exports more expensive. The Toyotas that they export to the U.S. and other countries all around the world become less attractive to foreign buyers. This, of course, is a big threat to an economy like Japan's that is so dependent on exports. It can quickly tip the economy into recession. Japanese stocks are now plunging. Now, I'm going to talk about this carry trade in the next segment with Mr. Michael Pento, but John Rubino talks about it as well in his piece. He says this, a rising yen or a strengthening yen also threatens the carry trade in which businesses borrow yen at really low interest rates, and they use the proceeds to fund artificial intelligence data centers and leverage treasury bond speculation and all kinds of other cutting-edge things. Eliminate this source of cheap funding and related activity grinds to a halt, causing trouble for everyone. I'm going to talk about this more in the next segment with Mr. Michael Pento, and he'll explain it even in more detail. But Rubino says this in his piece. It was almost prophetic. He said that the U.S. equity market should react so negatively to this rally in the yen is the shape of things to come, and an indicator to investors of how interrelated U.S. equity valuations are with the global monetary system. Now, let me put that a different way. I think it illustrates how addicted to easy money our economy and our financial markets and our real estate markets really are. Now, if you take a look at what happened to stocks early last week, they declined significantly. On Monday, we had every major U.S. index drop more than 3%. Now, of course, prior to the big drop on Monday, there were the pundits that came out and said corrections like this are absolutely normal. Now, I won't quote many of the analysts that made those claims. However, as you know, if you've been a longtime listener to the program, I certainly disagree with his assessment. In fact, I like to look at what the smart money is doing. As I'll talk about with Michael Pento coming up in the next couple segments, Warren Buffett, who's not known for making many mistakes when it comes to investing, sees the current market a bit differently. It seems that Mr. Buffett just unloaded a whole lot of Apple stock. And of course, Apple is one of the darlings of Wall Street. In fact, Mr. Buffett, according to a Zero Hedge article, has increased his cash from $88 billion to what is now an all-time high of $277 billion at the end of the second quarter. Buffett also sold a net of more than $75 billion worth of Apple stock. So when you look at the Apple stock that Berkshire Hathaway now holds, is down almost 50% as of March 31. The world economy and the stock markets have long been propped up by currency creation, and I believe we'll likely see the Fed go back and cut rates. Now, I would not even be surprised to see the Fed have an emergency meeting prior to their next scheduled meeting at the end of September and have some emergency rate cuts. Now, we'll have to see if that happens or not, but keep in mind, It's my view, and I believe it's the view of many others, that the Fed has just one play left in their playbook. There's just one page left in the playbook of the Federal Reserve, and that is cut interest rates and create currency. Of course, should that happen, which I believe it will, I think that will bode very well for tangible assets like gold, silver, and other commodity-based type assets. Now, if you request our special report titled Tax-Free Retirement Income Strategies by going to requestyourreport.com, I'll not only send you the report, I'll also send you a copy of the revenue sourcing book, and I'll also send you a copy of a couple of my recent newsletters that dig into these topics in detail. So when you go to requestyourreport.com and let me know where to mail the Tax-Free Retirement Income Strategies report as well as the revenue sourcing book, you'll also get a couple recent newsletters, and you'll be able to use all this as an additional resource as you look to navigate what I believe is going to be a very difficult investing and retirement environment lying ahead. So again, requestyourreport.com to get the report. It's all free. It's without obligation. I'll be back after these words to chat with my special guest, Mr. Michael Pento. Stay with us. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Michael Pento. You've undoubtedly seen Michael as a frequent commentator on many television programs as well as many radio shows. Very happy to have him back. His website is pentoport.com. He is also the host of the very popular podcast, The Midweek Reality Check. Michael, always a pleasure to catch up with you. Thanks for coming back on today.
Pleasure, Dennis, as ever.
So, Michael, going into, where I should say we're recording this on Tuesday, August 6th. This will air in just a few days, but no shortage of excitement as far as stock markets are concerned. Big drops in the market. How do you see it? Is this the beginning of, or a preview of things to come, or what's your forecast?
Well, I think it is a preview of things to come. I don't think it's necessarily that we're going over the Niagara Falls with the barrel right now. This is more of what happened lately is, Japanese Nikkei Dow down 12% in one night. I mean, that is a manifestation of the unwind of the yen carry trade. And the yen carry trade, and give you a brief description of it, people were borrowing in yen at 0% interest rates for 15 years. I mean, it was just a ridiculous central bank, Bank of Japan, BOJ repression run wild. In other words, what happened was in Japan, they had so much debt outstanding that if the central bank didn't buy all of it, interest rates would spike and the country would be rendered into a depression. That's where they are now in Japan. So the central bank was buying everything, and that wasn't really a bad outcome right away, because post-COVID, every central bank on the planet was basically at 0%. So Japan had a 0% interest rate, massive interest rate repression, and they were just joining the rest of the world. But the rest of the world ended that ZIRP regime, and they moved interest rates, for example, in the United States to 5.25 to 5.5%. And when your interest rates are 5.5% in the United States, and you could buy a treasury bill and earn that risk-free in an overnight, short-term treasury, well, you do that. What you do is you borrow yen at no cost, 0%, and you park that money in a U.S. treasury or in U.S. stocks or in U.S. commodities, or for that matter, stocks and equities and bond markets around the globe. And then what happens is you make the interest rate spread between 0 and 5%, for example. And then also you get paid on the currency, because the currency was depreciating. The yen was depreciating. So the dollar is appreciating. You're getting 5%, and you're making money in the currency trade as well. So it was a really big liquidity boom for markets, big, huge source of liquidity. And that all turned around this week when the BOJ raised rates for the second time. And they raised rates all the way, Dennis, to 1/4 of 1%. and that huge increase in interest rates and that above negative nominal rate caused, to many people's surprise, an unwind of the carry trade, which means that you have to sell your treasuries, you have to sell your stocks, you have to sell your commodities, you have to sell your Bitcoin, and you have to sell your dollars after you do that, and then you have to buy back the yen that you were short. And that's what happened. That's why the yen surged after being down 40% in the last few years. The yen surged in value, and that caused an air pocket in stocks. But here's what you really need to know, Dennis, and your audience. The yen carry trade was one source of liquidity that is now gone. And it's one source of liquidity that's joining other sources of liquidity that are now gone. For example, you just mentioned, Fed funds rate went from 0 to 5.3%. That's a real Fed funds rate of north of 2%, and it's been that way for a year. A major source of illiquidity in the market now. Fed's balance sheet has been shrinking for the better portion of a year and a half to 2 years. Now we're down from $9 trillion balance sheet all the way down to $7.1 trillion. So it's the rate of change that matters in investing. So that's another source of liquidity that's gone. You also have the inverted yield curve. That's a source of liquidity. Banks tightening lending standards, another source of liquidity gone. And then the reverse repo facility, which was once $2.5 trillion, now it's only $300 billion. So all of the fuel that was boosting asset prices to astronomical levels, and I mean real estate, I mean equities, I mean credit, all those things, all that monetary fuel that was boosting those asset bubbles has now gone into reverse. So it's a matter of time before the real collapse happening. And it won't be an episodic, truncated sojourn into hysterical mania like we saw in the last few days. It's going to be something very protracted. It's going to last a long time. And all the Fed can do is go back to zero and QE. And we all know what happens when they do that. It's called intractable inflation.
So, Michael, what does the Fed do here? I mean, they're signaling a rate cut in September. Is there an emergency meeting in light of these circumstances to say, wait a minute, we've got to do the only thing we know how to do. We've got to go back to easy money.
I mean, you know what I find? Yeah, I'm laughing, but I actually should vomit. You know what I find disgusting? I actually find it disgusting that somewhere along the line, the Federal Reserve, the Treasury, government, powers that be decided that, since we don't have a currency that's linked to anything, it's just confetti, we can just print it ad nauseum and at will. We don't need to be fettered by the strictures of any kind of monetary metal like gold. We could just print money. So why do we need to have a recession? Why do we need to have a bear market in stocks? We'll just print everything away. What a eureka! Woo! This is like Einstein, part 2.0, E equals MC squared. Let's just print every problem away, every hiccup in the stock market and every hiccup in the economy. Well, now you have major deformations that have formed. For instance, home prices to income ratios are at all-time record high. And you see homeownership is unaffordable in this country anymore. Well, what's the right thing to do, Dennis, when that happens? Home prices should fall. And I see the morons on Wall Street, and even some of these, really well-recommended and highly esteemed gurus like this individual from the Wharton Business School, whose first name is Jeremy, saying we need an emergency rate cut. We need to emergency just bail out Wall Street right now. Well, you already destroyed the middle class of this country. The middle class of this country can't afford food. They can't afford shelter, and they can't afford medical care. And you want to now panic to bail out Wall Street because they had a bad week? Shame on you, Mr. Jeremy.
So, Michael, it seems that a lot of smart money certainly saw this coming, and we've talked in the past that the market's been overvalued for a very long time. I thought it was interesting that Mr. Buffett, Warren Buffett, who doesn't make many mistakes investing, unloaded about half his Apple stock as Apple was running up. He's sitting on what, $230 billion in cash now, all-time high. Where do you see the market ultimately going here, just say from now to the rest of the year, understanding there's an election, understanding the Fed may try to intervene? What is Michael Pento's forecast?
Well, my forecast is that I think that we are into – this is how I analyze markets. I look at the second derivative of inflation, and clearly we're now back into disinflation. And I look at the context between the second derivative of inflation, deflation, that dynamic in the context of how healthy the economy is. And clearly the economy is sick and getting sicker. So I think we're in sector 2 now in my 5-sector investment spectrum, which is disinflation. Sector 1 is deflation, when prices actually fall, which is actually very bad news for stocks. It's very bad news for the economy short term, but it's exactly what the economy and markets need to heal. It's part of the healing process. Now, will the Fed allow that to happen? I don't think they will. I think they're going to resort back into ZIRP and back into QE. But my forecast is to go back short term. We will go back into deflation. We will go into recession. The Fed will be reticent to cut rates because they know where this is leading. They know it's going to happen when they go back. The market will understand that the Fed is unable to ever provide investors with a real interest rate, a real positive interest rate. Impossible. So interest rates will be negative. Asset bubbles will soar. The middle class will be hollowed out. The top 1% will get richer and richer, has been the trend. And most of Americans will be relegated to penury. But that's okay because the elites on Wall Street, all they care about is the health of investment banks, banking system, and the stock price.
Well, my guest today is Mr. Michael Pento. He is the founder of Pento Portfolio Strategies. And, Michael, we've got about a minute and a half left in this segment. Would you like to talk a little bit about your work?
Well, I put out a podcast called the Midweek Reality Check every week. It's available for $50 a year. It has a 5-week free trial if you don't want to invest at $50. And it gives you the salient economic data of the week and the absolute independent and valuable and important interpretation of that data so you understand where we are in the investment spectrum between deflation and stagflation and the context of growth there within. And then if you have $100,000 to invest and you are a U.S. citizen, I'll actually invest your money myself in that strategy called the Inflation, Deflation, and Economic Cycle strategy.
All right. Well, you can learn more at pentoport.com. And the good news is I'll have Michael back for one more segment at RLA Radio. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with the founder of Pento Portfolio Strategies, Mr. Michael Pento. He's also the host of the very popular podcast, the Midweek Reality Check. And, Michael, you had mentioned that we are in what you said, I believe, was Sector 2, disinflation, versus Sector 1, which is deflation. And we've talked in the past about just the massive levels of debt that exist both in the private sector and on the balance sheet of just about every government around the world. Isn't significant and severe deflation, like we saw in the 1930s, isn't that at some point inevitable?
Well, I think both things are inevitable. I think the natural gravitational forces out there are deflation. I mean, think about what we just talked about in the first segment was home prices. When home prices are this elevated, they're much higher than they were in nominal terms, even in 2006. I mean, home prices are up 50%, Dennis, in the last 4 years. Home, which just sits there and deteriorates slowly into the ground. And taxes go up and maintenance costs go up and insurance goes up. That house is up 50% in the last 4 years. The natural gravitational forces would say home prices need to fall about 40% to bring them back to historical normal mean. if you look at asset prices, they were close to 200% total market cap of equities to GDP. Now they're about 185%. They should be closer to 100%. That's fully valued. So in reality, the stock market should drop about 45% from here. But if that happens, there wouldn't be a solvent pension plan or bank or shadow bank in the nation, or maybe even in the planet. So what's going to happen is you're going to get both dynamics. You're going to get inflation. We just came off, in 2022, we had record high inflation. In the summer of 22, record high inflation in this country, never before seen, close to 20% in reality. I mean, I know it was 9.1% according to the hedonically and substitutionally bastardized CPI, personal consumption expenditure price index. I get that, but even there it showed up at 9%. But in reality, if you look at, hey, what did my cost of rent go up? What did my insurance do? What did my taxes do? What did the cost of eggs and milk and cheese and bread do, and bacon? These are the things that went up 20% per annum, 2 years in a row. So, we had that inflation. Now the monetary fuel has been cut off. The helicopter money is gone. And now we're going to have a crash because that's where the market wants to take things. It wants you to be able to buy stocks at a fair value. It wants you to buy a house at a fair value. If left alone, that's where they would go. But I doubt the Fed can do that because I just said it would bankrupt the financial system. When the Fed really gets nervous is when money markets don't function. You can't float commercial paper. You can't float a junk bond. I mean, 40% of the Russell 2000 is unprofitable, and 50% plus of all small job creation comes from small companies. They're unprofitable now in the good times, supposedly good times. What happens when we have a recession? You're going to see mass layoffs, money market funds freeze, and the Fed will have nothing else to do but reliquify the markets by massive QE and another explosion in their balance sheet. And here we go again off to the races. So if you don't understand the dynamics of how to invest between deflation, disinflation, stasis, reflation, and stagflation or intractable inflation, then you're going to always be chasing, your tail in this market.
Michael, do you think the Fed can be successful in going back to the only page left in the playbook and trying to reflate everything? I mean, as you stated, real estate's overvalued. The stock market's overvalued. Isn't it inevitable, to use that term again, that these financial markets do have to crash and reset at some point? I mean, at what point will the Fed not be able to do what they've done to this point?
I have a very good answer for that, and I've thought about it a lot. Normally when the Fed, normally being since 1987 on, what the Fed does is they come in and they engage in something called interest rate repression. So the salve, or the healing process, the remediation process of a recession is to say we have asset prices crashing because debt levels have become too onerous and asset bubbles have bursting. They became too big to support anymore. They start to crash, and what do? Is they bring down interest rates by printing money, which is antithetical. I mean, printing money is inflationary, but that inflation is pushed into the bond market first, and then bond prices rise, the yields fall, and home prices become more affordable because mortgages go from say 8% to say 2% or 3%, and that makes the bubble grow again and makes everything fine. That's the playbook that they've used because long-term interest rates came down when the Fed started to cut short-term rates and print money. And the answer to your question is, what if the Fed comes in this time, starts to print a tremendous amount of money, trillions of dollars, that's what they did in the past. The Fed's balance sheet went from $700 billion to $9 trillion since 2008. So they will do it again, I'm afraid. But what if this time they do it, instead of interest rates falling, prices of bonds crash? And the reason why they would The odds are higher this time that bonds would crash, Dennis, is because we are an insolvent nation. That's a new phenomenon. We are now insolvent. Our assets minus liabilities are negative if you include the unfunded liabilities. And we have trillion-dollar deficits already to start from. So the supply of bonds, the deficit, in my calculation, the deficit would be between $5 and $6 trillion as the recession becomes manifest. So you have a supply tsunami, and then you add to that insolvent condition and supply constraints. You add to that the fact that we have inflation that just came off the boil at a record high level. So if you add insolvency, if insolvency and inflation are your salient issues, and then you start to pursue this ZIRP and QE and helicopter money, again, the odds are much higher that you'll get interest rates rise on the long end of the yield curve. And if that happens, you'll get no relief in the housing market, and you'll get no relief from the stock market because interest rates will be soaring. And that's when reality hits. And that means it just blows up anyway.
So, Michael, do you see that as an outcome potentially in this next cycle of the Fed going back to easy money?
Yeah, I see it as a salient and likely risk. I can't put the odds are. I can't give you the exact odds. 71%. I can't do that. I don't know, but I do know that what has changed this time around is every other time before this, when the Fed was entering this debt monetization scheme, deflation or disinflation or quiescence in inflation was the salient issue. And now it's not. Now we're at 3% inflation and heading higher if they start. I believe the inflation will head higher if they start to cut rates again and start doing this debt monetization scheme. And like I said before, we have never seen the debt and deficits this high in this country. So you're starting at $35 trillion in debt. You're starting at 125% debt to GDP. You're starting at $1 trillion in interest payments on the debt. That's your starting point. So that risks are very high this time around that you'll see interest rates not respond the way they have done in the past.
Michael, we have time for just one more quick topic of conversation here. If you take government deficit spending out of the equation, it seems to me that we might already be in a technical recession, and the only thing keeping us out of a recession is the government spending a lot of money and that they don't have and throwing it out into the economy. And now you're seeing signs. Corporate bankruptcies are up significantly. I think the highest level in like 14 years. More chain stores closing, more locations. I mean, it seems like the recession might be here.
Yeah, I mean, I'm an outlier on this. I've been an economist and market strategist for decades. I don't think government spending does anything but destroy productivity. Deficit spending can work for a year or so, but deficit spending the way we've done actually destroys productivity and creates inflation. That's the long-term effect of deficit spending. So count me down as someone who doesn't believe you can save the economy by just issuing debt. In fact, every time the deficits have exploded, it's been during a recession. So I don't think there's anything that they can do to save us. The real issue is that the middle class has been eviscerated because of the inflation that has been inflicted upon them over the past 4 years. That is the real issue. Debt. We have a massive credit bubble, a massive housing bubble, an enormous equity bubble existing concurrently. And now that the monetary fuel has been cut off, the reality is starting to hit. So look for, weekends and days like we had this past week, where you see Bitcoin, drop, $10,000 a unit, and you see the Nikkei Dow losing 12%, the Nasdaq down 10% in just a couple of weeks. Look for more of that, and in a more protracted and intense scenario.
Well, the clock says we're going to have to leave it there. My guest today has been Mr. Michael Pento. He is the founder of Pento Portfolio Strategies and the host of the wildly popular podcast, The Midweek Reality Check. You can learn more at pentoport.com. That's PENTOPORT.com. Michael, thanks for joining us today. Love to have you back down the road, and appreciate again your time.
Looking forward to it, Dennis.
We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Thanks again to Mr. Michael Pento for joining us on today's program. Hey, if you've not yet requested the special report that we are making available this month titled Tax-Free Retirement Income Strategies, I would invite you to go to requestyourreport.com. Let me know your name and where to mail the report, and I'll be very glad to do that. Why should you be thinking about tax-free retirement income strategies? In fact, you may not even be aware that it might be possible under current law to make changes, to do planning now to be able to have actually a tax-free retirement. Well, the report available at requestyourreport.com will go into detail, but let me give you in this segment a few logical arguments to be made for strongly and seriously considering the implementation of tax-free retirement strategies if they're available to you in your personal situation as soon as possible. Now, actual strategies are available in the report titled Tax-Free Retirement Income Strategies, again, available by visiting requestyourreport.com. So let's just look at a few of these arguments in this segment. First of all, argument one. Future income tax rates will likely be higher than current income tax rates. That's my opinion. That's the opinion of many people that I talk to at my new retirement rules class, many radio listeners. If you have a different opinion, that's okay. But if future income tax rates are higher than they are currently, then taking a look at how you can have a tax-free retirement income before these rates increase would be just good planning. Now, here's the reality. If Congress does nothing, in calendar year 2026, income tax rates will return to the rates that were in effect in 2017 after they're indexed for inflation. When the Trump tax cuts were passed in 2017, personal income tax rates were reduced for 8 years due to an existing rather obscure law relating to tax cuts. So that means in 2026, we will all likely, if nothing changes, be paying more in income taxes. I want to just give you a quick illustration. If you look at income tax rates for a married couple filing a joint tax return, this year, you can have taxable income of up to $383,900 and stay in the 24% tax bracket. Let me say that again. If you are a married couple filing a joint return, this year you can have up to $383,900 in taxable income and stay in the 24% tax bracket. If you're a single taxpayer, it's exactly half that, a little over $190,000. Now, in 2026, based on my estimates, you will jump into the 25% tax bracket at $94,301 in taxable income. So this year and next year, you don't get out of the 24% bracket until you have almost $384,000 in income. In 2026, you'll jump into the 25% bracket at about $94,000 in taxable income. So the bottom line is this: if no new tax package is passed, income tax rates will rise by a good margin in literally a matter of months. That's 17 months away. Yet in the next 17 months, you have 2 tax years in which to do planning. That's a good reason to go to requestyourreport.com and get this report. Second argument I'll make is that income tax rates are at an historical low point when compared to the level of U.S. government debt that exists. Now, in this report, again available at requestyourreport.com, I have a chart that shows income tax rates compared to national debt. And if you take a look at where income tax rates were back in World War II, when debt was a little over 100% of gross domestic product, the top marginal income tax rate was 94%. Presently, the top marginal income tax rate is 37%, reverting to 39.6% in 2026. So in the whole scheme of things, when you look at what historical income tax rates have been, current income tax rates are quite low. Now, the third argument is really stating the obvious. Government deficit spending and interest carrying costs on the U.S. government's debt will require that income taxes are higher in the future. As I talked about on today's program with my special guest, Mr. Michael Pento, at the present time, interest costs on the U.S. government's debt have exceeded $1 trillion per year. Now, there was an article recently published on Market Insider that talked about this, and actually, the $1 trillion mark as far as carrying costs on the debt was published at the end of October in 2023. Now, if you calculate all this using U.S. Treasury data, and this data discloses monthly outstanding debt balances and average interest costs, last month, annualized cost of debt marked a doubling over the past 19 months. In fact, many of you probably saw the article that stated that 76% of all personal tax revenues are now used to pay interest on the debt. Now, it's very obvious that this is totally unsustainable. When 3 out of $4 that you and your family send to Washington are used to pay interest on the debt, it tells you that the end may be near. And what does that mean? Well, it likely means, in my view, that one of the solutions that the politicians may look to collectively is higher income tax rates. Now, that's why I would invite you to get the report available titled Tax-Free Retirement Income Strategies. Visit requestyourreport.com. I'll be glad to send you a complimentary copy as well as bonus information. You'll get a copy of the revenue sourcing book. You'll also get a copy of a couple recent newsletters that discuss these topics in detail. The entire box of information is available to you for free. Consider it to be a free second opinion. All you need to do is go to requestyourreport.com. Let me know where to mail the report as well as all the other information. I'll be very glad to do so. Again, requestyourreport.com is the website. That's all the time I have for this week. Hope you got something you can use, and I'll be back again next week.